What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is June 23rd of 2020. Well, folks, I hope you are having a fantastic day wherever you are. And in today's video, I not only want to spend some time diving in to the altcoins that are leading the market as we continue to see both enterprise and DeFi take over the center stage for people who are showing their interest, but outside of that as well, I have a good conversation today with my good friend Alex Saunders of Nuggets News, one of the largest Australian YouTubers in the crypto space. And we're not only going to be talking about the emergence of all the technology going on in the cryptocurrency space, but predominantly to sit in and talk about something he calls the digital thick shake theory, which could be one of the leading reasons why we see cryptocurrencies move in the next cycle. So we've got a lot of interesting conversation coming up right after our quick sponsor. Our sponsor for today's episode is TaxBit. The IRS recently released new forms in 2019 that require all taxpayers to attest to whether or not they traded cryptocurrencies, no matter if they made gains or losses. TaxBit automates your cryptocurrency taxes, enabling you to effortlessly track, calculate, and report your transactions. Easily connect your exchanges to securely sync your transactions and run them through TaxBit's tax engine. Generate your completed tax forms with a single click. Founded by tax attorneys and CPAs, TaxBit is the most trusted cryptocurrency tax solution. Get 10% off your tax plan today with a free trial using promo code DataDash. All right, everyone, so let's go ahead and quickly dive through the market here, do our portion of the daily update here. Taking a look across the board for the market, we've got a good amount of cryptocurrencies in the green. However, the vast majority still of which are in a no trend scenario from 1 to 2% to the upside or downside. We've got a lot of different DeFi plays still continuing to lead the market, guys. Again, check constantly to see what kind of trends here are leading the market, and you'll see that DeFi is the clear winner. Bancor here, for example, making a massive comeback over the last few months, up nearly 17%. Ren as well, up nearly 12% here. Compound, after its first correction backwards, still seeing a nice 10% bump up here. And again, as you go across the market here, any of the significant movers are really usually going to be in DeFi. Again, also some of the CeFi plays like Celsius as well, up nearly 6%. So it's again important to note these things. And outside of that as well, guys, I want to share with you I'm going to be speaking at Remote CryptoCon. They're giving away 500 free VIP tickets. So if you guys want to come see me, as well as a very nice list of different speakers, definitely check it out. And I have the link down below in the description. All right. So let's go ahead and talk about Bitcoin. We'll dive into alts, and then we'll jump into this conversation. In regards to Bitcoin, interesting thing that I've started to kind of pick up here, the highs have been in a relatively consistent range. Now you've got one anomaly here, but I think it's enough here, especially with the line of support here, to justify that, and also with declining volume, that we're probably setting up for a pretty big move here into what appears to be an ascending triangle, right? So I want to see here, again, as we get above 10,000, I want to see an actual solid close above this level. Some would say that we got one over here, but obviously it was faded off very close after, probably within just a couple of hours. So I want to see a nice breakout above here towards 10,500, 10,600, and I want to see a close on that day. I want to see volume coming in. Right now, if I take a look at BLX, right? Oh, sorry, wrong BLX. That's where TradingView does sometimes. It always puts it with the NASDAQ index for some reason. Yeah, so BLX here, right? Volume is generally abysmal in actual liquid Bitcoin market. So you can see this not only when you take a look at things like BLX that are much more neutral in their volume, but you can see this in pretty much all major metrics for volume. So I want to see that volume coming through, as well as price discovery about 10,500 to 10,800. All right. So going on here to talk a little bit about some of the major DeFi plays, Lend BTC or Aave finally seeing its first major correction in some time. Again, after a crazy 6,200% rally, 62x from the bottom here compared to Bitcoin. Really incredible stuff. Now, taking a look at the daily here, we can see that this is, again, much like how things come up quickly, things will come down just as quickly as well. So I think that this is going to have a pretty sharp, 50% correction, something similar to that. And again, we've also got a support range around what would be 50%, which is 900 sats from a high of around 1,800. So I think that that's a pretty reasonable target. I'd maybe look to possibly get some personally around that range, but I don't really know. I'm going to basically wait to see how this price plays out. The correction might be a little bit more significant after a 62x. That can tend to happen. Kyber Network still holding it pretty good. Like a lot of these DeFi plays, starting to pull back a tad bit, especially for being one of the major leaders. Now, again, as you guys know, we got in back here in September around September here, around 2,200 sats. So we've been holding this for a good amount of time. And then again, in this case, I'm just looking to hold this for a much longer term period of time, because we've not only broken out of the major line of resistance here, which is why we had the volume breakout over here, But again, turning off the drawings here and just going to the weekly. Very nice, clear reversal formation. I like to see this, right? And again, any points of resistance you could draw from the the lower end highs here, or the higher level of resistance here, whatever it may be, right? You can draw your trend lines however you want. There's really not any points of resistance for this until we get up into this range of around 30,000 to 40,000 sats. So there's going to be pullbacks, but I don't really think there's going to be anything significant or any difficult ranges of price to get through on a month-to-month basis. So RLC, another interesting one to keep an eye on. This one again broke out of the line of resistance, similar to Kyber Network, set significant higher lows, and now is looking like it wants to reverse back up and continue even higher. Again, next point of resistance here is going to be somewhere around here, around 10,000 sats. After that, you go up to 14,000 sats, and after that, I would say the next significant level is going to be 30,000. I think there's a good chance this one can continue to grow, and I love what RLC is doing as a project. Now, REN, gotta say, REN has been taking the center stage over the last few days in regards to decentralized exchange discussions, and really at the end of the day being able to actually do swaps to some degree over the Ethereum network and other assets, or basically cross-chain assets. Now, again, we talked to, in the newsletter, a lot of people are like, oh, REN, is selling off mainnet, do you still have confidence? And in the newsletter, I told people, I was like, guys, REN's one of my top 3 picks, right? REN is going to probably come back roaring strong after, because this is not just some kind of, buy the hype, sell the news kind of thing. REN is an incredibly interesting project, and the team's been working on this for a very long period of time. So if you don't understand what REN is, I recommend you check out their website, learn about what it means to be able to bring all these different assets into the DeFi ecosystem in a non-custodial way. And as we can see here, ever since then, REN's practically doubled, or at least if you take the absolute high, it nearly doubled in the past few weeks. Last one here is Kava. I'm watching for Kava to have a breakout to the upside through an ascending triangle. We've got the higher lows that are consistent here. We're looking for a third time here over the next few days around 10,000 sats, and a consistent resistance range. Again, leading towards a continued breakout, getting back above this resistance range up here and continuing the breakout higher. I think that, if you're interested in DeFi governance protocols or DAOs, in regards to stablecoin generation, or doing things where you can actually use multiple cryptos as collateral, I think Kava's kind of got that going for them in that case, to be able to utilize multiple different types of collateral outside of just Ethereum and ERC20 tokens. That's what interests me about Kava's approach, and being able to bring a broader asset class into DeFi. Right? If you just take it on a market cap basis, getting Bitcoin into DeFi is a very interesting proposition. It's hundreds of billions of dollars, right? So you're dealing with a $170 billion asset that still is yet to really be pulled into DeFi outside of wrapped Bitcoin. That's what interests me. So anyways, keep an eye on Kava. Now, going over towards our substantive conversation for today, I want to talk a little bit about what we're going to be discussing with Alex Sanders. Not only are we going to be talking about all the exciting things going on in the crypto space, but we're going to be building off what we talked about yesterday in regards to the news, in regards to the Fed continuing to progress slower and slower towards negative interest rates, and also providing as much liquidity as possible throughout the world. So let's go ahead and we'll dive into this conversation with Alex Sanders from Nuggets News. Alrighty, everyone. So in today's video, we have the opportunity to be sitting down with my good friend Alex Sanders, who's out from Australia. He's one of the larger YouTube channels for the cryptocurrency space based out of Australia. Alex, thank you for making the time, man. I know we've got a lot of interesting things we're going to dive into in regards to the broader crypto space, DeFi, the more macro picture. I think you and I kind of have that specialty. We enjoy taking a step out of the crypto space sometimes and talking about what's going on in the global economy. So thanks, man, for making the time.
I'm looking forward to it, Nick. I just think there's so much going on in the two worlds that are now colliding, and it's probably just the most fun thing to discuss, and it's just so important for the crypto and traditional markets.
Absolutely, man. I think you've really been leading the way in it because, as someone in the crypto space who has that kind of traditional background, I've been really looking for good content out there talking about, and what's going on in the multi-trillion-dollar equity markets, what's going on in the bond markets right now. There is so many interesting dynamics as we see central banks rushing to record levels of monetary policy for QE, as well as low, if not negative, interest rates. I mean, you think back a year or two ago, it haven't even been a reality in the United States. So I think it's pretty wild that we're on the cusp of it. But I guess kind of keeping more relevant to what a lot of people are probably interested in, man. In regards to cryptocurrencies, we're living through some interesting times. Today we just had a rejection around $10,000 down towards around the lower $9,000 range for Bitcoin. This is like, what is it, our fifth, sixth time of trying to get past 10K here over the last few weeks. So I'm just interested, man. What's your take on this? Do you think we're going to be able to get a break here soon, or are we going to consolidate for a little bit longer?
I think the way I've been looking at it is ever since we had the crash, the COVID crash, and then that liquidity crunch where everything sold off, we've had a pretty strong correlation. And there's been times when Bitcoin's sort of broken away and tried to do its own thing. Altcoins have been performing reasonably well just in the last few weeks when Bitcoin's been a bit range bound. But I think the one thing that always had me a little bit nervous as markets kept wandering higher and Bitcoin was wandering higher was that thought that if markets roll over here, is Bitcoin going to sell off the same, as it did in that first leg down? And I was looking for the sort of, the moving averages and the fibs and the places where you'd expect the market to roll over compared to, everyone's comparing it to historical crashes like 1929 and that. And we just kept going higher and higher. And then we got to this place a little bit higher than everyone expected. And sure enough, we rolled over and had a pretty big leg down today. And surprise, surprise, I think Dow's down around 7%, Bitcoin's down around 10%, as you said, from the wick, depending on where you look. But I think that shows us that, yes, the correlation is still there, particularly in times of the crunch and the liquidity when everyone's just hitting the sell button all at once.
Yeah, man, speaking to that correlation, I think that's the really interesting point, Alex, that I know a lot of people have debated that we have to see that kind of divergence from equities against Bitcoin. But I'll be honest, man, I think about it this way. When I was looking, when Paul Tudor Jones, for example, came out and he took his position on Bitcoin through the Bitcoin futures contracts, he also put out a chart in his report that showcased like the 4 hedges in this environment. And he ranked equities as number 1. And then I think it stepped into possibly either bonds or maybe like precious metals. And then it led to Bitcoin. And the thing that I always kind of propose as a potential of how this thing could all play out is that maybe it is that equities just keep rallying as their central bank monetary policy, and Bitcoin keeps rallying as well as gold and other different types of assets. Because if you have guaranteed buyers and pretty much infinite liquidity, you're probably going to see that happen across all markets. We're going to see big upswings and volatile downturns when there's not a guarantee of that continued influx of liquidity.
I think the most interesting chart I've seen in recent weeks is the M2 money supply ratio to the US stock market. Mm-hmm. And the ratio is actually nowhere near a high. So what's that is telling us that there's a lot more money that could flow into equities that's just sloshing around out there. And I have a bit of a joke that I think Greg Mannarino taught me this one. Money doesn't die and go to money heaven. Money is out there and it's looking for a home. And once we have wider implemented negative interest rates, there's just more of a reason for people to chase yield. Like we've seen people going to these crazy CLOs, the high risk bonds, the junk bonds and that type of thing. But once we have negative interest rates, if you've got these trillions of dollars, why not go into equities? And there's a lot of money out there. Now, obviously, we'd love for it to go into that new asset class, the crypto market, and maybe Bitcoin can absorb a lot of that liquidity. But I guess they're the things that I'm thinking at the moment, that I know people are saying it's overvalued and you look at the traditional metrics, but I think the Fed have actually printed too much money. Everyone really raced to rescue what they thought was going to be a nasty and long downturn. And here we are, it's sharper than a V. I was joking the other day, it looks like a clock, almost like the 11 o'clock, and the Fed's got their hand on the rocket clock. But anyway, so yeah, they've rescued the market really well. And a lot of people say, well, maybe COVID wasn't as bad as we first thought. Things are getting back to normal in a lot of places. But the government spent $3 trillion, the Fed printed $3 trillion. So now you've got that money out there, and maybe it was too much, and maybe that's why asset prices are going up so much.
Yeah, but you were mentioning we showed the chart earlier today in the video. It's funny you mentioned it, the M2 to the SP 500 ratio, and it's amazingly shocking how you see just how much more room we have to go with how much the Fed printed. I mean, most of that money is going to find its way into equity markets, whether it's the money that they gave to hedge funds during the initial phases of QE, or the countless amounts of dollars again that have been going through all the bailout packages and the additional layers of QE. And it's amazing, they're still not looking to reduce it right now. It's looking to maybe reduce the pace of it, but the Fed is still in talks of making additions to QE. So I mean, it's just incredible, man. And other central banks, as you know, they just continue to follow afterwards.
I think the Fed are now conscious of inequality as well. So Jay Powell has come out and said that the Fed are not responsible for that at all. Very strong wording. I think that someone on Twitter the other day was sharing his statement from back in 2012 when he first joined the Fed board. And he was saying that if we start doing this, it's going to be very hard to unwind. It's going to push up asset prices. The market's going to cheer us. And not only is it going to be hard to unwind, but what we're doing is basically compressing volatility. And when you start to taper back the bond purchasing and the QE, you're also letting the volatility out of the bag. And that is exactly what we've got, and why he had to backflip 2 years ago when he was speaking about raising interest rates and on this set course. Sure enough, he was wrong and they had to drop to zero. And now they're saying things like, we'll never go negative. They're saying them the same in Australia, but they've been wrong at every turn. And the market has dictated what they have to do. And now the US market, the futures are pricing in negative rates, I think, before the end of the year in some markets. So, yeah, I think the Fed have, again, they're just making this up as they go. That's why they're starting to say things like, you need to do more fiscal spending. And they're trying to pass the baton onto government because really they're out of tools. But the main problem is they've printed all this money. And what it's really, I guess, magnified is the problem that it doesn't really work or get into the real economy. The rich get richer. We've all seen those charts and the inequality. And at the moment, they're stuffing in trillions. And look at assets going up. But we've got, 40 million unemployed. Some of the stats that I read about the US and, child poverty and these things are just, they're crazy for a country with so much sort of wealth. And it's very obvious now that the Fed is saying our next program is Main Street. And they're trying to get businesses to lend. But that's just... Is a business, do you or I, if we're running a small, medium business, want to go into more debt just to pay our staff? We're uncertain that our restaurant will be okay in 3 months or maybe it's 6 months. So none of these things get money into the hands of real people. And the few occasions that it has, where we've got those stimulus checks or whatnot, we've actually seen in the US inflation start to pick up. I saw on some of the grocery items, it was up 3% in May alone, which is like the biggest jump in years and years. So that's the problem. With all the money they've printed, it hasn't turned up in traditional inflation measures, which I know you and I have both talked about how they're kind of fudged. But the problem is if they now try to fix the inequality by getting money into the hands of the real economy, that's when we maybe could see a bit of inflation.
Yeah, man, I think, again, as I've always talked about, one of those non-traditional metrics for looking at inflation are things like the Chapwood Index that actually measure things like, rent, your mortgage, along with that as well, things that usually wouldn't get measured in the CPI or Consumer Price Index. And I'm telling you, it's already been bad enough as is because you've had the bubble in asset markets that plays a large role in the cost of living for people. And then now when you start to get that into things in the everyday lives of people, man, it's going to be incredibly difficult. I think it's this really difficult situation. As you said, it's a catch-22 for the Fed and central banks now because for years, as you mentioned, they constantly suppressed any kind of volatility, continuously pressed asset prices higher. And that spring effect that you would normally get from the volatility is just going to be massive when they finally stop these programs. And again, if they run out of tools to actually keep up that buy-side activity, it will be hard, I guess, to bet against infinite liquidity and negative interest rates for some time. And we've seen in Japan and Europe, it can last for a little while. But eventually, man, it's going to come down with a vengeance. Japan's economy has been stagnant for the last few years. I think in this environment, when there's no extra tools to use, what do you do? There's really not much. So I think this is really where I think we've got an interesting opportunity, Alex. One thing you and I have been focusing a lot on is the cryptocurrency space, of course, but more specifically towards the DeFi space, because in DeFi, there's not only a lot of interesting utilities, but one of the clearest ones, I think, right now is the kind of interest earning opportunities, the ability to actually earn serious returns in your capital and not be correlated so much to any specific asset market and to be able to hedge to some degree against inflation. So, I'm curious to just get your take, man. There's a lot going on in DeFi. We've talked about it a little bit on the channel here. What's kind of catching your eye right now in the broader DeFi space?
We've actually started doing a monthly Ethereum DeFi update with a friend of mine who's more of a developer in the space because there is just so much happening. And we can talk about 20 or 30 projects and still not cover everything because it's just been this explosion of, obviously everyone's familiar with the lending and earning the yield, but now we're starting to see some really cool things that come together as the DeFi Lego, they call it. So some of the ones that I've seen are like the set protocols where you can program in certain strategies, but you can now pair that with things like your own decentralized sort of hedge fund, and you can make up your own digital assets. There's one where you're streaming your wages. And if you expand that out further, you can think, well, if I get all my income and I can see that visually as how much money I have coming in versus all my expenses, how much I have coming out in a real-time measurement, you can see that, I'm actually going backwards. I'm going to be in more debt if I keep spending this way, or I need to adjust my investment strategy. It's too risky. I need to go into more and get this DeFi yield. Otherwise, I'm going backwards. So they're just a couple of examples of dApps I've seen that are being now built into the things like the Argent wallet, that Web3 space. That's very exciting. But I think stable coins, something that I used to think was so boring, and I've been in the space since 2012, since Tether first came out and had its rumors, and that space has just really changed in the past 12 months, as you know, all the different stable coins. But everything that we just touched on about all the money printing, that ties right back to this explosion of US stable coins. And do they print more money? Do they have negative interest rates? How is that going to impact stable coins? Can you actually penalize a negative interest rate on a stable coin? These are the things that I really want to maybe explore today, and I've got a few theories I've been working on.
Yeah, man, just to take a quick step back, you're right about that, Alex. It's a bit difficult to get across to people because I know stable coins aren't as fascinating as, emerging altcoins or different cryptocurrencies like Bitcoin that, do offer a lot of value. I think it's hard for a lot of people to get why is it the stable coins are so beneficial. But it's the sheer kind of autonomy that you get with a stable coin. You can not only own dollars in a virtual wallet compared to a traditional system where you have to have it in a bank vault, or when you want to send payments, you can do it peer-to-peer. Like it'd be like me handing cash to you rather than having to go through a traditional payment processor. So it's very autonomous. And above all, you get so many different opportunities that you can plug into a wallet. We've done that with Digifox in this case, where we plug in all these different services. And you mentioned Argent as well. There's a lot of great smart contract wallets that allow you to just instantly plug into all these systems. And Sabler, that one where you can streamline your income. I mean, that's huge. And when you can start to kind of cross-layer and start using them as Legos, like you said, and build on top of one another, you can build some really unique financial experiences. Now, I think, again, DeFi right now is still in this bubble. At the end of the day, it's still very small right now. And I think we need to still see some more improvements in the space to kind of scale it out to a broader audience. But speaking to that point, Alex, you were talking about and that kind of theory you've had, I really like the interview you did with Brett Johnson talking about the dollar milkshake theory that he's been proposing, this idea that there's a massive demand across the world right now for US dollar liquidity and again, just liquidity in general. So I'm really curious to hear, not only, maybe you could explain for those who may not know about Brent's kind of theory, to talk a tad bit about that, and then how your theory of the the digital thick shake theory is a little bit different. Because I've been thinking along the same lines, man, about this kind of theory about how DeFi's got one killer application, and it could really start to scale us out to a much larger audience in the world. So I definitely want to give you a minute to just take that away and kind of explain it to people.
For sure. And as you said, people perceive stablecoins as a bit boring, but for me, it is the next step before people go the step further, and that's when Bitcoin and other crypto assets explode in value. But I'll walk people through to that conclusion, hopefully. So the Brett Johnson's US dollar milkshake theory goes something like the world reserve currency being the US dollar and a lot of the debt being denominated in that means even if you're in another country, if you're going to borrow some money off these big commercial banks, it's normally done in US dollars. So all around the world, you have this big need for US dollars, and they refer to all the dollars that are outside America as the euro dollar system. So it's actually nothing to do with the euro, which confuses people. They think of a chart like, euro US dollar pair or something when you say that word, but it's not. It's just any dollars outside of America. So at the moment, when the Fed are printing all this money, a lot of these other economies aren't performing as well as America, but they've got all this debt. So there's basically this huge demand for dollars to pay down the debt. And so imagine the world, and they all have a straw into the US, and the Fed prints $1 trillion, and then they wonder why there's not a lot of inflation in the real economy, or they just see asset markets go up. And similarly, when the ECB or other central banks print a lot of money, a lot of the time that just still makes its way into the US, because they've got a better performing stock market, or their bonds have got a 1% yield where the European bonds are at minus 1%. So you've got this really interesting dynamic where there's all this money that's sort of going into the US, and at the same time sucking out US dollars to try and pay down the debt. So that's why all these other currencies are just going down in value relatively, up until recently. I guess that's changed a little bit. The dollar's been a bit weaker, but that's basically his theory. And the Fed have had to open up these swap lines directly with other countries to fill this plumbing, the huge need, because it's so inefficient to try and get money. In Australia, for example, or a number of countries, if you're trying to get a lot of US dollars in loans, it's a hard process. It's expensive. They're not readily available. So not only have the Fed opened up those swap lines, and they've had to be plumbing these repo markets because those banks don't want to lend to each other, and then they lend to these other banks. So that side of the system's frozen up a little bit. But if you think about what is actually happening in the DeFi space and stablecoins, anyone can really get their hands on now a US dollar pegged stablecoin. Now, you can either do that by just downloading any old app and buying some of the decentralized stablecoins, or you can even buy the USDC or tethers through a DEX. So as long as you've got an on-ramp of a local Bitcoins or an exchange in your country, or an ATM, any sort of on-ramp, all you need is that smartphone and that app, and you're into the ecosystem, and you've got US dollar stable coins. Now, obviously, you can mint your own as well if you're a little bit more of an advanced user and you know how to use, say, the Maker system, and you can mint your own coins with anything as collateral. Well, at the moment, it's Ethereum, and then they added, I think, BAT token was next. And then recently they've added Bitcoin. So the wrapped versions of Bitcoin you can have as collateral. Now, other things that they're experimenting with are like the domain name. So data-.eth, maybe that's really valuable, and you can actually use that as collateral. And then we've got companies like Realty is an example of a real estate one, where they're going to tokenize your house as long as you're the owner and you've got to do the legal paperwork. But that can be your collateral to get a loan. So there's going to be all these fantastic ways that you can generate your own loans. But everything is just going back into this theory of people being able to get their hands on US dollars a lot easier than any banking system. In the middle of Africa, you don't need a bank. Forget all those money remittance, all those transfer wises. It's taking this even a step further to the fully decentralized peer-to-peer model, where basically anyone can get their hands on dollars, send them to anyone else on the planet. And compared to the legacy system of the Fed trying to give it to commercial banks and then trying to lend it to the local bank,
multi-step process,
it's a bit of a joke, and it makes it seem like a thick shake that's got all these straws in it, and no one can suck any milkshake or thick shake out. So I just think this digital theory, who knows what it's going to be called, but we've got lots of people now starting to talk about this. And the reason I think it's so interesting is that the guys at the macro level don't really understand DeFi yet. And the guys at the DeFi level, a lot of the developers don't really understand the macro side of things, what's going on. So it's only been the past 12 months where, even though I've been researching this for years, it's really come together in this clear picture, this huge multi-trillion-dollar need for dollars that maybe the DeFi ecosystem can satisfy. And then the step after that is everyone realizing, well, yes, I've got my hands on dollars. Everyone wants them at the moment, but they're being printed into oblivion. All fiat currencies are being printed into oblivion. The next step is going into the digital currency that is scarce, the Bitcoins of the world, gold as well. Ethereum's monetary policy is strengthening. So that's where it gets super interesting.
Yeah, Alex, taking a step back, again, just talking about the severity of this issue, I think back about 2 years ago in 2018, we really started talking a little bit more about the macro economy. And one of the big stories we talked about was the hyperinflation crisis in Turkey. And that was directly caused by what you referred to earlier, dollar-denominated debt. Basically, countries borrowing from the United States in terms of US dollars rather than the Turkish lira. And just to kind of explain, this issue of dollar-denominated debt in a very simple way, let's say, for example, Turkey borrows $100 million from the US government. The key issue to keep in mind is that Turkey has every obligation to make sure that the Turkish lira doesn't lose value, because if the Turkish lira, for example, loses half of its purchasing power to the dollar, that $100 million loan is now the equivalent of the same amount of work you'd have to put in for $200 million because your lira has lost value. So again, this is one of the key issues, as you talked about, Alex. It's why the dollar has remained so strong over the last few years, because it has become, as the world has become this global economy, the central point of liquidity, the central point for purchasing power in one singular currency. And going on towards the broader picture here, as you mentioned with DeFi, it opens up this channel now where dollar stablecoins can move anywhere in the world within less than a few seconds. And you can send any amount you want for a fraction of the cost you'd have to, do for a wire transfer, a fraction of the weight that you'd have to have in a traditional transaction, and you can put it in any opportunity in these decentralized financial systems. I think it's really incredible. And as you were speaking in this case, you can start to kind of circumvent the entire traditional banking system, not just in the sense of payments, not just in the sense of opportunity, but really being able to say, hey, you don't even need a bank account anymore. Someone in Kenya now can literally download a wallet and receive dollars from you or I, and from Australia, from the US. And it starts to build a whole new system where, again, as you mentioned, it's going to be the tool that satisfies that macro need, but it really starts to meet towards that original message where, people can actually start being their own banks. It's not just send and receive transactions in a Bitcoin wallet like it used to be 4 or 5 years ago, just sending it from one point to another, just hodling it. You can actually have any asset you want now. And along with that as well, hopefully in the future, as you mentioned, we're going to get to the point where we don't have to just rely on USDC, stable coins that are backed by a dollar in a vault somewhere, which is really interesting. It's still cool and very powerful, but we'll actually get to a point where you can create credit on demand by collateralizing assets of yours and tokenizing them on chain. We have to still, I think we're still a ways away before really scaling that out and being able to tokenize a broader range of assets. But when those systems come in, when the legal structure for tokenizing that and issuing those tokens and giving them legitimacy comes into play, and being able to actually use them as collateral in these protocols, man, it's going to be incredible. But I think the biggest one it's going to become even more clear, and it's the one we're using right now, is digital assets like Bitcoin and Ethereum. I think that eventually that's going to be one of the key standards as those become multi-trillion-dollar assets. They'll be the digital gold or the digital kind of asset to utilize as collateral, the new kind of gold standard by means of the long-term vision.
Yeah, and I used to be a Bitcoin maximalist from 2012 up to probably 2016 when I finally started to read about Ethereum and opened my mind a bit more to it. And I really don't think that there should be that tribalism at all. Ethereum is clearly a technology play, and Bitcoin is clearly evolving into a gold standard being its most important role. Now, what we've seen recently with those wrapped Bitcoin versions, and for people at home, that just means you put Bitcoin into a ERC20 version so you can use it on Ethereum. And again, we've got decentralized versions of that and more centralized versions, but all it means is you can now use your Bitcoin as collateral. So think about if Bitcoin grows to this $1 trillion market cap, which I think it's going to easily get to, we can now use all that as collateral for these different loans again. So it's just the whole ecosystem sort of feeding on itself. And I know what people are already saying in the comments that, it can't do that. It can't scale. Bitcoin fees are high and Ethereum fees are high. Well, Bitcoin doesn't necessarily have to. Hopefully the Lightning Network will, and Liquid and other side chains. But now that we've got Bitcoin on Ethereum, we only really need Ethereum to scale. And just the past week or so, a few of these projects that we've been covering in our monthly research reports we do, it's been unbelievable to watch them get to this point where no one sort of knew that this was happening. And then within a month, you've got Amigo come out and launch their plasma chains. And on the same day they launched Tether on their plasma chain for instant free transactions. Then you had Loopring this week launch, I think it was Loopring Pay. Again, it's instant free transactions. And the other one I'm really bullish on, which still hasn't got much attention, is the Raiden network, which is Ethereum's version of the Lightning network, but slightly different with the state channels it sort of uses. So we've got all these things that are on mainnet, as well as some of the ZK technologies and the roll-ups you might have heard of. So these things are all sort of 4 or 5 scaling technologies that are good to go. You can use them today for free instant transactions on Ethereum. So I'm very excited that we're almost to that point where we can serve the whole world.
Absolutely, man. I think it's just a matter now of systems basically taking on these different scaling solutions. I saw a bit of the interview you did with the one of the CEOs of Amigo. I mean, it's amazing, man. We're entering into this time where scalability, that's been a topic of discussion over the last few years, is finally getting to a point where we have some actionable tools that, as you mentioned, they're ready to use now. It's just a matter of integrating them into the interfaces that people are familiar with, maybe doing, again, a little bit more back-end checking and security checks. But, I mean, outside of that, I mean, this system's, it's getting ready to go, and now we've got all these great utilities to utilize this scalability for. And as you mentioned, once you start moving other assets onto Ethereum, again, the only priority there is to make sure Ethereum scales and make sure that Ethereum is still secure. And I think now that you've got these solutions where you can actually, for the first time, break the blockchain, I guess is the trilemma or whatever, where basically you have to give up either security, scalability, or what's the third one? Scalability.
So speed.
Yes, speed. Yeah, that's it. Yes, that's exactly it. So the three ones that, one of those three you're going to have to give up. Now we can actually have all three. So I think it's an incredible time, man.
And that's where I guess we were joking before that people say stablecoins, that's boring. And when we put out our research reports, people say, that's a bit boring. And while you're looking at fundamentals, look at the next, where exchange is going to be listed and that type of thing. And then all of a sudden this year, Kyber's gone up 500%, Loopring's gone up 500%. All these DeFi projects are exploding, and that gets people's attention finally that, okay, these are interesting.
Yeah, and one thing you keep to keep in mind, Alex, as you were kind of mentioning, with the advent of stablecoins, you have a system that starts to act as a replacement for your traditional finance applications or your bank account. And what's great is that we know that over the next probably 2 or 3 years, let's just take it as surface level, the vast majority of banks aren't going to allow people to buy crypto. It's not because it's per se illegal or anything. It's just that they just simply don't want to offer or deal in those services. Well, the moment you take your dollars into the form of a stable coin on an Ethereum wallet, it's a matter of that wallet offering you the ability to buy crypto. And most of them do. It's starting to become a standard feature now where you can actually get access to any digital asset you want. You can get access to, again, as you mentioned, pegged assets, real world assets, all kinds of fascinating things. And it just kind of opens up the window of opportunity for everyone to have an equal opportunity at that point. It's not a matter of you being a high status accredited investor. It really opens it up to everyone. It's permissionless. And I think that's the fascinating thing about it. It goes back to really that original message, as we've seen the emergence of smart wallets in the space and DeFi, of Satoshi's original message of being your own bank. And if you want to be in USDC, you can be in USDC. If you want to be in another stablecoin, you can. Or if you just want to be in digital assets, you can. But still, you can benefit from all the great things that DeFi has to offer that can amplify and further amplify the benefits that already exist in the crypto space.
Yeah, and we sort of joke about these cliches about, Bitcoin will save the world and make the world a better place. But once you've got that concept of everyone just being a digital citizen online on a decentralized Web 3.0, that really does, level the playing field, or whatever you want to call it. There's no longer this world where money gets printed, it goes to the banks, the Cantillon effect where the wealthy get to spend it first. Anyone can start a blog anywhere in the world and start to get paid in US dollar stable coins. They can earn a yield on their money rather than being penalized or, all at cross-border. It's just all happening, and it's very exciting.
Yeah, man. I think that's the next step here is when people start using USDC in other countries, and when we finally start seeing it. We haven't seen it in DeFi yet, to be realistic and fair. I think it shows that we're in such a early level of infancy for this space. But the moment when you start to see USDC and other stable coins being lent out for real world use cases to businesses and countries that usually struggle to get dollar liquidity, due either to capital controls or due simply to the fact that dollars are just hard to come by. I mean, Alex, that's the moment I'm going to get super excited about this space. And I think that's really what's coming up here in the next few months to the next year. Hopefully I'm not too optimistic on my timeframes, but I think that we could see that very soon in the space. But, kind of speaking to the broader picture, man, I know we've talked a lot about this theory about crypto. We've talked a lot about the current status of the market. We just talked the other day, there's just actually really a couple moments ago in this case, about what's going on in traditional markets and what's going on in equities in response to the kind of crazy monetary policy we're seeing. I know we talked a bit about equities, but I'm curious to hear your thoughts about gold and silver. We talked about precious metals last time we chatted, and I'm curious, gold's been going flatline since April. Silver starting to pick up pace, the gold to silver ratio dropping like it did in 2008. I mean, I'm curious, man, what's your thought on it? Are you getting bullish around this time, or?
Silver's a very interesting one, isn't it, with that ratio blowing out? So, look, I've been a gold and silver bull for a long time, since the last GFC. And it's important to remember that gold's basically at all-time highs in every currency apart from the US dollar. So in Australia, gold was around that 1,200, 1,400 mark for a very long time, the past few years. And it was crazy to think of it going to $2,000. And then here it is. This year it got up to 2,000, I think it was 2,900 and something Aussie dollars. And those numbers seem far off, but I'm sure that is going to happen in the US sooner or later. So all these currencies taken in terms of passing the baton. And tying back to everything we spoke about, if the US have to print so many trillions of dollars that confidence finally gets lost, that maybe they are going to default on some debt or have to really hyperinflate their currency to pay all those, I guess, promises and liabilities, then this is where you see Bank of England, Mark Carney, saying we need a fairer system. And a lot of these guys around the world talk about a new sort of world currency or something that's politically neutral, and they're basically describing Bitcoin. So that's all really good for that purpose. But getting back to gold and silver, I think 5,000 years of history, it was always going to play its role in the next crisis. I think what it showed when it sold off so sharply was how people complain about BitMEX and scam wicks and liquidity crunches, but it's for an asset that's $9 trillion to sell off that sharply. And the ETFs, so the GDX and the GDXJ, the miners ETFs, they sold off they were down 50% and trading at way under the net asset values of what was in those actual ETFs, because it's just the liquidity crunch. So you can complain about BitMEX, but the biggest, most traded liquid markets in the world also had those huge plunges and bounced straight back. So yes, I'm very bullish on gold. I think gold goes way, way higher with all this money printing. It's just a matter of when. Look, I'm not sure how much you believe in the conspiracy theories about price suppression and naked short selling of all the futures contracts, but I think all that is sort of coming to a head as well when we saw the physical demand couldn't be met.
Yeah.
And
yeah.
I was going to say, and sorry, you go.
No, I was just going to build on it. It just adds to speak to your point, because that was true even in the ETF markets, because you started to see a very big divergence, I guess, on the broader kind of assets of these ETFs for gold, like GLD and SLV. They were actually down towards really dramatic levels, as you mentioned, dropping 30-40%. And at the same time, if you kept up with what was going on for physical silver and physical gold, man, you couldn't get any for that week in March. I mean, it was incredible, and people were paying up to like $20 an ounce for silver on some markets. So it's incredible to see that divergence, because GLD and SLV have maybe 1 ounce of the actual precious metal for every 100, 120 shares that they issue. And the problem is that there's not much legal status in those ETFs that state that you own it. That's the scary thing. And then the futures contracts as well play into that.
Yeah, I was going to say, I used to, a lot of people complain about that, but use it to your advantage. So we actually, being a bit of a trader as well, when opportunity presents, one of the trades we did was a bit of an arbitrage between the paper and the physical market. So when the silver ETF gets down to $13 or $12, buy it, and the price of coins is still $22, because they're going to meet in the middle somewhere. Or even if it comes all the way down, if you actually want to buy a physical silver, you haven't lost out. So that ended up being a fantastic trade where they sort of met in the middle somewhere, and those premiums are going to always narrow eventually. In terms of what's happening with silver, I think one of the reasons it's lagging is because it's lost a little bit of that monetary premium, because we've got so many other options. So gold's very expensive, and the average man, he's going to probably buy dollar cost average into silver before we had cryptos if they want to get out of the traditional system. Now you've got so many other options, and I think that maybe took away from silver a tiny bit. A lot of that crowd, you would have seen it, even the influencers and the guys selling their newsletters and all that, they used to promote gold and silver, and they made the switch to crypto. So you have to admit that some percentage of those people are putting money elsewhere now. But like all things, I think silver will bounce back just because of how scarce it is. Things like stock to flow. As soon as that ratio blew out, everyone started talking about the ratio, and then silver played catch up. So this is just even the trader-driven world we live in these days, with the Robinhood apps that have gone crazy recently. Everyone's sort of a trader these days, and they want to jump on the hottest thing. And I think gold and silver and all the precious metal stocks could be like, an alt season of sorts when things get really moving.
Yeah, man, I think you're very right on that. The changing environment that we're living in right now, the peak amount of kind of retail volume that we're seeing, people who've never traded or invested before coming into the space, not only for equities but also crypto. I think as we were talking about earlier, I think it was Coinbase who came out and they said that they were picking up 5 times the normal monthly volume that they normally got back. And I think this was March or April. And you had a lot of people who bought the dip, surprisingly enough, who were everyday people, smart traders and investors. We want to keep them around, comparative to just buying at the highs. But it's fascinating, man. You start to see a huge spike in the new brokerage accounts that are doing 0-fee commission trades. And that's why I think everyone started to offer that, because that was the standard that people were looking for. They want to be able to do fast, frequent trades. And most platforms realized, that wasn't where their business was. It wasn't in, charging commissions, as being able to have the deposits there, right? So again, it is fascinating to see that, and just to see this whole changing landscape. But Alex, man, I think we've dove into pretty much every single topic, man. But it's been a fascinating conversation, and just to let people know again who might want to check you out. I bet many people here are probably fans of the Nugget News channel. I know I've been for the last few years, man. Happy we got to meet in person and still keep in contact to this day. But people want to learn a little bit more about you and stuff, and keep up to date with maybe some more in-depth content like the additional materials you guys share outside of the channel. Where would they go to?
Yeah, thanks a lot for having me, Nick. It's been a pleasure. I knew it would be a great conversation, and really enjoyed it. So, Alex Saunders on Twitter, I'm pretty active. Nuggets News on YouTube, and website is nuggetsnews.com.au, where we've got a heap of free resources, and we also do some premium reports and research on those coins we were speaking about before. We've also got a community, so not a trading group with trade calls. It's more of a sort of educational community if people are interested.
Absolutely, man. I think it's incredible. I think there's so much going on right now between all these different markets. It's one thing to be engaged in crypto. I think that's a fascinating industry. As you mentioned earlier, one of the key selling points I can think of about crypto markets is the kind of magnitude of multiples that you could see in Bitcoin versus, say, maybe gold at a $9 trillion market cap already. But again, man, to be able to be there for the macro perspective and continue to grow your capital in other places, it's a huge benefit to just know where all the opportunities lie right now. So, Alex, hats off to you, man. I appreciate you coming on for the conversation. We'll get you back on here soon.
Thanks so much for having me, Nick.